Hi and welcome. Thanks for joining me today on this webinar and this weekly update with Hilltop Wealth Solutions. And it's good to have my advisor team as well. So Beth, Bill, and Matt, thanks for joining us today. If you're following us on Facebook, thank you so much. And if you want to hit share and share this great information we're going to talk about today, that would be great. As well as we're going to have several slides today because we've got to cover a lot of material and we thought it would be helpful. So if you want to review the slides, you can grab those off of our website, and I'll share where that's at the end of the session. As well as if you're calling in on the phone, maybe you want to look at those slides at a later time. I know it's hard to reference on the phone as well. So, we certainly had another very up and down week in the markets, and things continue to be volatile from a market perspective and certainly from a health perspective. And so our number one commitment here and hope is at Hilltop that all of your families and friends are safe and practicing the social distancing and helping us get through this global pandemic. So let's go ahead and jump into our agenda today, and then I'll ask my panelists to certainly participate as well. So we got three key points we want to bring to you. First one is a market update and the importance of diversification. So we want to talk about that. Secondly is we're still looking for a trading range, and we'll talk more about that and dive more into that. And then the third is we want to dive into some of the details of the CARES Act. The CARES Act was signed, the $2 trillion act that they've talked about in the press, and there's obviously a lot of detail there. There's a lot of information that is continuing to be worked out, hour by hour. So we're seeing changes continuing. So we don't know all of it. We know what the overall act is and what's involved in it, but we wanted to address some of the key things that we think would be valuable to you as clients and those that are guests as well. So let's go ahead and jump into our agenda. And let's start off with this emotions of diversification. So maybe I'll ask Beth, and again, we're all practicing social distancing, so working from homes or from our individual office. And Beth, let's start off the discussion on diversification, if we could.
I was listening in on a different webcast earlier today, and I heard diversification defined as this. You're diversifying properly if it never feels good, if it feels as if you're always doing something wrong. And I think this graph can illustrate what that means. Diversification is with our model portfolios of allocating against different asset classes. And our goal is to try to smooth out a little bit more on the bottom, although we may be giving something up on the top as far as a growth projection. You can see that here on this graph. From the years 2000 to 2002, the S&P 500 was down 40% during that time frame, with 9/11 and those things going on and the recession that we had. Diversified portfolio was still down 18.6%. And so the concern is, well, yeah, I diversified, but I still lost money. What good is that doing for me? And then from 2003 to 2007, we go through a growth cycle. The S&P 500 is up almost 80% during that time frame. The portfolio is up fine, almost 74%. But the concern would be, great, I diversified. I didn't make as much money because we're going to trail on the upside with the diversified portfolio, and so on and so forth through here. So ultimately, though, as you do maybe chop off some of those peaks in the growth period, but you also lose them on the bottom as well. And then ultimately during this period where you're either losing money or not making as much money, but look at the bottom line, growth of $100,000 in the S&P 500 grew by almost 123% to growth to $222,000. But in a diversified portfolio where you're smoothing out those lines a little bit, the total return is 151%, and you end up with $251,000. So the objective of diversification is that you may lose money, but the whole idea is you're not losing as much money. You're smoothing out those peaks and valleys. And that's why we feel that it's important for us and for Hilltop and our models to get a more consistent return over time. So that's what diversification is all about. Yep, you may be giving something up on the growth period, um, but you may not be collecting as much loss on the downside. So ultimately, we're looking for a more consistent return for our clients, and that's why we feel diversification is important over time in there. So that's how I would interpret this graph.
Great, thanks, Beth.
And I think people get a little frustrated, you know, because what's reported on the news and the media are things like the Dow Jones Industrial, the S&P, and the NASDAQ. And those people that are watching closely go, well, wait a minute, the Dow went up 11% last week. Why did my portfolio go up 11%? Well, when the market went down 20%, your portfolio also did not go down 20%. So just as an add-on to what Beth says, that paying that close of attention is not prudent, because you're gonna, it's all designed for that steady as we go, both on the downside and the upside.
I think it's a forest and a tree situation, Bill, right? If you're looking at it every moment, you're looking at the trees. If you're checking it every day, where we want to look more at the forest, where we win by losing less over that same period of time.
Well, because this money is for the rest of your life. It's not for next week, and it's not for 6 months from now.
Right. As long as this is the money for the rest of your life. For shorter term goals, those dollars shouldn't be in the market anyway.
Yeah, and I think that the other thing that we have seen in working with clients and those that are on the call and the webinar today is that we said this before. We've come off of highs. I mean, all-time highs. So it peaked, and most everyone remember their high number. They remember their highest number, and then it's come down. But if you look back over the last 12 or 18 months of return, the return is not as bad as you may think. And I've had a lot of clients say that, the last 12-month return, actually, I didn't realize that, because it did peak in that January, February of this year. So if we move on to the next slide, there's a lot going on here, but we really wanted to just point out some periods of time in recession. So Matt, maybe you can comment on what we're seeing here.
Sure. Again, this is just going back to recessionary periods to 1933, giving you different stock and bond performance. This is using an age-old 60-40 equity to fixed income ratio of what would my account performance have done during that same recessionary time period. And I think the complexity is, just because you're in a recession doesn't necessarily mean that the market isn't performing. So you can have, the world is not creating a recession traditionally based on what market performance is. It's primarily categorized in GDP terms. And so those two aren't the same thing. So you could have market pullbacks. You could have certain asset classes performing in a market pullback, or certain asset classes all performing even though you're technically in a recession, periods where you just have instability of growth, highly volatile, but that doesn't necessarily mean that you're losing money. Obviously 08, 09 financial collapse, as that bled over into the fixed income world, that really made it a very difficult time when you're looking at overall, hey, how did diversification work? I think the other thing to point out on diversification, stemmed with this, is, we've built these portfolios traditionally or primarily after the 08, 09 collapse, because we went back and addressed how do we protect from this happening again, or create more downside protection. And we've really added a lot of components to portfolios over the last 8 to 10 years to help curb some of this downside protection, instead of just being traditional stocks and bonds, and employing alternative strategies, things like managed future, real estate, preferred stocks, energy, those types of things. And what we're finding right now is, while that's definitely working, there are periods where you have uncorrelated assets can become highly correlated when you have a massive market reaction. And so, 08, 09, you saw market declines take 6-7 months for the actual declines. This happened in a 2.5-week time period. And so you saw the credit market spread pretty significantly, which hit the bond market. You saw obviously stocks drop significantly. And so those heavily uncorrelated assets became heavily correlated, which we're now starting to see that levelize and move back out, particularly with the relief package coming in, the Fed buying bonds, all of that. So we'll see some of this diversification actually start to help, I think, as trading levels kind of come into play, as more data comes out on where the coronavirus is going. But we're also seeing even things like your managed futures in your account, are up because those were shorting oil prices. And so there are things that are working against this heavily correlated market shock that we're seeing. But this, again, just because you're in a recession doesn't mean you can't make money. And so obviously we're just looking at ongoing strategies of how do we do that in this time.
Yeah.
Hey, Matt, something I just noticed about this slide for the first time is you have to go all the way back to that 1929 Great Depression to have U.S. stocks go down as much as they have in the last 3 weeks.
Right.
So when they add this recession, which, by the way, we have entered into a recession, we just don't know when we'll come out of it. When they enter this current recession on this chart, it will be close to the numbers that you see back on 1929 through 1933. That's pretty amazing.
Yeah, that certainly is, Bill. So let's talk about, we talked about trading range, and our second point is, we haven't found a trading range yet. And, part of it is we don't know. There's the unknown. We don't know when we'll start to see some declines in the amount of cases with the coronavirus. And so there's an unknown. So let's talk about that, the trading range and where we're at.
Well, we had a trading range from 3 weeks ago to today that was in excess of 30% from top to bottom. And last week, with a really good week, we had a trading range of about 25% in 1 week. And this week, that's narrowed to a trading range of about 5%. And so I see the trading range starting to narrow, but certainly hasn't developed the troughs and the peaks or the floor and the ceiling that I personally want to see yet.
Yeah, and I agree with you, Bill. 4 days, 5 days does not a trend make. You need more time within an established range. Personally, definitely a personal opinion because I don't know. It's just a thought. I think we've got some harsher days ahead, especially as, here in Detroit and in Michigan, we're looking at peak numbers as far as diagnoses of the virus not hitting until April 11th or April 15th, when the numbers really hit their biggest volume. So I think that we've got some troughs ahead of us. And so then, we've had this nice little more narrow trading range over the past week. I don't think that can be sustained quite yet. And that's, to our point, it's just too soon to start jumping in and making significant changes in the portfolio.
Yeah.
And if you look at technicals, you got the S&P that hasn't broke through the 2200 mark, which is good. And I think the other thing that is encouraging at this point is the volume of trading is down. So when you begin to look at this week being much more stabilized than last week and the prior weeks, when you see volume down, that is giving an indication for a couple things. One is algorithms aren't coming into play as much, and two would just be people, I think, are saying, okay, the market's really beat up. At what point do we just say, maybe we've oversold, or maybe we just pump the brakes and begin to analyze data before we just fire sale anything else? So that, I think, is good news, and ongoing stimulus, again, changes every prior investment theory that anybody's ever had, because they don't calculate in stimulus, which we might see more of.
Yeah, I think if any, on any of the press and news and shows that you hear anybody thinking that they're calling it and calling the bottom or when is it going to turn, nobody knows. So nobody knows. All right, let's move on. Keep this going. So let's talk about some of the CARES Act things, high level. So up to 90% of taxpayers are going to receive a check. Somebody want to comment on that for us?
Yeah, well, I think that that is going to be in many cases looked for and welcome to have it. This is definitely something that's changing hour by hour as far as information. I think we heard earlier today that some of the checks may not be out until September. There's been back and forth this week as far as people who live only and have only Social Security as income, and whether or not they have to file a return or file a special form, and it's been back and forth. And as we know right now, there's no extra paperwork needed on this. So I think welcomed money, but I wouldn't be standing at the mailbox in 3 weeks looking for your check to be in the mail quite yet. I think patience is going to have to come into play here.
Yeah, and it was just as fast as they brought this together. Remember, they brought this whole CARES Act together in days, not months and months and months. So they got it signed, and now they're just figuring out how they're going to distribute it. So if we move on to the next topic that we want to talk about.
Hey, Eric, I might make one comment about this slide before you move on.
Yes.
Is that remember that if you haven't filed your 19 and you're now over the limit potentially in 19, but you were under in 18, you might delay filing. And I do believe this stimulus money will get to taxpayers much more rapidly than some of the business loans, because the business loans are, have some hangups right now. So there might be some planning that could still be done if you haven't done your if you haven't filed your tax return. Now you may have earned less this year and you want to get it in and get it in before the 15th possibly.
Yeah.
Right. Taking a look at these single and married filing jointly numbers. I mean, I was laughing about it with the rest of you, is that it's important to me that I had my 2018 tax return filed, but not 2019 for where this is at right now. And remember that tax is not due until July 15th. And you guys can speak to Indiana, but here in Michigan, the state did change their policy. So state income taxes are now also due on July 15th here in Michigan. And that just got changed, I think, early this week. Had been April 15th. They changed it to match the federal return date.
Yeah, and Indiana's following that same thing. They're following the 90 days.
Yep, Indiana. Yep.
Along with the federal. So, all right, well, let's move on. And so you may or may know of someone that is in need of money because of what's going on, and they're thinking about drawing from their IRA, their 401k, and so forth. So basically, they are able to take money distribution from that account up to $100,000, which, by the way, is doubled. The 401k side was $50,000 maximum. They doubled that to 100. And then you can see that there's some tax benefits or ways to help minimize taxes. It's exempt from the 10% penalty. It's not subject to any mandatory withholding. You can repay it over a 3-year period, or you can spread the income over 3 years, whichever may be appropriate for you. Oh, and there's the loan provision I mentioned. So loan provision, excuse me, I didn't separate that out, has increased from 100,000 from 50,000 in a 401k. So obviously, if you're in need or somebody is in need of drawing from their accounts because of needing it to live, this is an available option, and I think it could be a good option for folks, especially since they're giving some different options on how you repay it or how it might be taxed to you. So if we move on, one of the things that we run across all the time is required minimum distributions. So let's talk about this. This is a big topic, obviously, for us in the work we do, as well as many of our clients.
You know, Eric, I had a situation this week with a mature widow that the tax savings to not do her required minimum distribution this year was in excess of $7,000. So this is definitely important for us to pay attention to. That it's going to be a planning opportunity for many of our clients that could be bumped, because what happened is her Social Security now wasn't going to be taxed like it was last year. And in the meeting with the CPA, we were planning on the withholding amount for this year. And I'm like, wait, we're not going to take any out this year. And then it was like, wow, this is great.
Yeah.
Now, that would also work on the other end of things where people who, with the required minimum distributions, push them over the level so that they have to pay the higher Medicare premium rate too, right? So if less income coming in, may at least for a year drop them into the lower premium range for their Medicare premium as well. So there could be some savings there for some folks on the higher income level.
And as a reminder on this, we had the Secure Act. I'm now getting them confused. The Secure Act and the CARES Act. So the Secure Act that was passed January 1st, which pushed out required minimum distributions from the age of 70 and a half to 72. So that still exists. But if you have taken a required minimum distribution, even this year, you can see based on the slide, or if you're on a call, there's a 60-day period that if you've taken it within the last 60 days, we actually can get that out in penalty-free and no harm, no foul. If it goes beyond 60 days, then there is some kind of a laundry list of if you qualify, and it's coronavirus related, you still may be able to get it back in, but we really work from this 60-day window. The other thing we think about is this is an opportunity for Roth conversions. So potentially you could take what was your required minimum distribution and look at converting that to a Roth. You normally can't do that. You cannot convert your required minimum distribution into a Roth. You have to take your required minimum distribution, and then above and beyond that, you couldn't convert to a Roth. So it's a way of saying, well, maybe my taxes don't change this year, and I'm able to convert some money into a Roth IRA. So we just need to, we're thinking through this with each of you and our clients to make sure that it's right for your situation.
Yeah, it's also, you don't have to do it on inherited IRAs either. So if you're 40 years old and you received an IRA from your parents, and you don't need the money because you're still employed, still have a paycheck, but you have to take out a $4,000 distribution from an IRA that creates a tax consequence that's unnecessary, that you also qualify for deferring that required distribution for this year.
Yeah. Thanks for bringing that up, Matt. Yeah, so that certainly could come into play. So again, each individual situation is different, but it is here. The other thing we should mention is that this also does not change the qualified charitable distribution. I know all of us on the panel here, we have a lot of clients that do those every year, which is direct charitable contribution to your charity of choice or many charities of choice. And you can give up to $100,000 annually once you're over 70 and a half. So if you're over 70 and a half, you can give up to $100,000 annually out of your IRA. And that is the best way to give to charity, really, because it comes right off the top. This does not come into play. That still is in existence and a way to give to your charities. So just something to keep in mind. So we definitely are aware of this. We know that there are situations that we're looking at to determine really what's best in each individual case.
Yeah, and if we stay on that topic, and if you flip the screen, there are some real advantages to the CARES Act with regard to charitable gifting. Beyond just, for the folks who can make qualified charitable distributions above age 70 and a half. But, this is a country that likes to help out and we like to give. And the CARES Act made that a little bit more accessible with this first one. Anybody at all can give $300 to a qualified charity, and that's above the line. So even if you're taking a standard deduction, you'll be able to write off, just like you used to be able to write off up to $300 of charitable contributions. And there's a lot of organizations out there right now who need help and are going to need help. So, maybe people take a little bit of their money that's coming in from the CARES Act, the $1,200 or $2,400, and give some of it back to help out. With that $300, up to $300 is tax deductible for you. So that's a pretty good thing. that anybody can take advantage of.
So Beth, little tidbit there is, we haven't been saving many of our receipts because everybody's been doing the standard deduction. So that first $300, save those receipts for your CPA.
There you go. A little housework there. Hang on to those receipts.
Yeah, and when I saw this initially in this proposal, yeah, I kind of felt like the others, my other panel members felt that $300 isn't a lot, but yeah, collectively, as Beth said, when if we get a lot of people doing that, it adds up to a lot of money going to really, really good causes. So let's just dive in a little bit, not deeply, but into the AGI limit, and then how they could potentially wipe out their tax liability. Matt, why don't you take it? Your turn.
Yeah, so essentially you in years past you could only give a certain amount that was allowed to be deductible. This time they're going to increase that, so you can go up to 100% of your adjusted gross income gifting. So let's say your adjusted gross income is 80,000 and you gift 80,000, you essentially wipe away all of your income for the year. So that is something that you could look at, and where that potentially could be really helpful. Let's say you're 62 and I'm just thinking of planning. So if you're 62 and you have an opportunity to give this year, you want to give, you're also going to consider giving next year, you could potentially double up your giving this year, get your taxable income down to an incredibly low amount, and then qualify for government subsidy on medical insurance premiums next year. There's a lot of different things that you can do planning wise to help yourself going forward. Just, you got to get a little creative with it. You have to feel comfortable with it, but those are various loopholes that we see. I don't want to say we're exploiting them, but we're definitely looking at opportunities to help people long term, because as we all know, medical insurance is not something that's cheap. So, but if you give up to 100%, or you can deduct up to 100% this year, so that's a big deal. That's a big deal especially for people who have committed to certain projects, whether you're helping your church with a building project or an alma mater or whatever the case may be. We would definitely encourage you to look at just thinking outside of the box on giving, if that's something that you're inclined to do.
And one caveat there to remember is that this does not apply to gifts made to a donor advised fund. It needs to be directly to an organization, a nonprofit, a church, not to your donor advised fund that you then write grants out of in the future. It's got to be a direct contribution this year to take advantage of these write-offs.
Yeah. And we have a question around a little bit on the required distribution. We've had this a couple times. So since there is no required distribution and I've already taken my required distribution for the year, can I give back half of it and keep half of it?
Yes.
Simple answer, right?
Yep.
The answer is yeah, sure.
Yep.
So if there's a cash flow, if you want to keep half of it and put half of it back against it, if you're in that 60-day window, you can do that. So there is that flexibility. Basically, the way to think about it is that there is no required distribution. So you can take as much as you want or as little as you want or not. So good. Well, let's move on and talk about some takeaways. Before we do, we've had, I know, several questions that have come about in us talking to clients and asking us how we're doing. How's the team doing? How's the Hilltop team doing? How the advisors are doing? So I'm going to ask you guys to comment. How you doing in all this?
My golf clubs are getting rusty and I'm getting pretty tired, but healthy, and the whole family's healthy. So doing pretty good on the south end of the Hilltop geography.
On the north end, things are pretty good here. Working away, every day. It feels like a typical work day other than I'm here at the house. And my sad news for the day is that I got my bicycle out for the first time yesterday with the good weather and immediately blew out not just the inner tube, but the tire. So it won't be able to go into the bike shop noon. But on the positive side of things in my family, my 7-year-old nephew has finally gotten tired of his video games after 3 weeks away from school. And after stubbornly refusing for years, has finally learned how to ride his bike. I got the video yesterday. So that was a big accomplishment for him. And we're pretty proud of him for that.
Matt?
I love quarantine. I love it. It's slowing life down. I get to hang out with my family more, and I've also finally started to learn and play the guitar. So I've spent a lot of time. My fingers hurt really bad. I've pretty much already signed up for the next Hilltop gig. You know, next time we have a client's event or something, to play music in the background.
Be the entertainment.
Oh, really?
I like karaoke, so I'll probably sing along. You know, if we're gonna have some fun, let's have some fun. You know.
Yeah.
I'll surprise you with the music.
Next week on next video.
Probably not. We probably won't do that, Beth, but we're getting there. We're getting there.
That's
Hey,
great.
Erik, before you go on, one other thing I was thinking about, well, never mind, it's already on this slide, but I've had a few people ask me about student loans. And so if you're a parent out there who is either applying for loans, has loans, you have loans yourself or on your kids, there are some things that you want to take a look at there. So most of those, the interest rate has dropped to 0%. As long as it's an educational loan that's not subsidized by a bank or something, you know, or consolidated out elsewhere. So 0% interest, and it's my understanding that the payments are not due until September. So helping people out with additional cash flow needs. So if you can make the payments, I would encourage you to make the payments, since there's no interest being added onto those. But just something to pay attention to as another added bonus from that CARES Act.
Yeah, thanks for mentioning that, Matt. You know, we could have spent hours and hours just covering in detail, so we certainly couldn't put everything on the webinar today. And there's a lot of other details. So certainly if you have questions, reach out to us, reach out to your advisor, and we'll be glad to answer those. I also want to show you a resource center. I know all of you that are online here go to our website. So I want to make sure that you go to our website and go to the, there's a market volatility resource center, and we'll have on there continuous updates. You can log in there and have continuous updates. We will put the information today on there. Also on the site, if I go in, I'm going to go in and click that. I wanted to share that there was a good piece that was done about 2 weeks ago from a 60-minute piece that they interviewed a president of the Fed out of Minneapolis. You can see this coronavirus in the economy. It's a really good piece. This gentleman was involved in the 08-09 downturn, and talks about the experiences they had and how the Fed's approaching this. And so I would encourage you to take a look there. So if we flip back, let me flip back to the slides here, and we'll talk about our keys and what we're talking about. So it's not timing of the market, it's time in the market. What do we think about that? How we think about that for folks?
I think about that in the sense of not making emotional decisions, making well thought out decisions. We've diversified portfolios. We've talked about timeframes and risk tolerance and so forth. Nobody is going to be a hero. Don't try to be a hero as far as getting back in or through rebalancing or so forth at the very bottom of the market. Maybe next week we can talk a little bit about that. So it's being there. If you miss just a small handful of the best days in the market, it can really impact your long-term results. So you need to be there in order to take advantage of that. And that means being in the market and not trying to time your way out or time your way back in again.
Yeah. Hey, I wanted to take another question here that I think is relevant. And when you think about this, it's certainly, would be topic of discussion for the future. So since, we're at a point and a lot of people are working from home, we've talked about it, we've set the firm up that way. How do we think about real estate going forward? Will real estate take a hit, potentially commercial real estate? Will companies rethink it? How are we thinking about that?
I think it will, personally. I think people will determine, I think people have already begun to look at different ways to reduce overhead and have people work remotely, because we're becoming a very technological world. So I think it will. But I do wonder if it will actually create a correction in real estate or corporate real estate, where some of these places are just so overpriced. You're spending $10,000, $15,000 a month just to have property to employ 10 people. So I do wonder if that will bring some of those prices down, supply and demand, essentially, and people will begin to then go back to having some office front where needed, when it's actually affordable. Because I do think that a lot of companies, charge more than they need to just to cover their overhead expense that's getting a little bit out of whack. So that will be interesting. I think that'll probably happen with larger corporations or larger metropolitan areas, but we could easily see that happen in local remote places, or they'll at least begin to question, should we keep this going forward? So I do think it will have a long-term impact. Yes, is my opinion.
Yeah, I think certainly, and the resources that we have and that we're follow, and multiple different firms. I've heard comments from CEOs and upper level management that they certainly will rethink this in a lot of ways, making sure that people can work remotely, they can hook up quickly, and so when something like this comes up, there's a smooth transition. All right, as we move on, our next takeaway is potential opportunities the CARES Act bring. So we talked about just highlights of those. So any last closing comments about those opportunities?
There are lots of little pieces to this, little things like the $300 charitable giving write-off or student loans. I think that it is worthwhile if you can, and I'm sure we can put something in the resource center. I think it'd be a good idea of a good summary of the plan, and taking you may not be a business owner and think, oh, well, it doesn't apply to me and I'm going to get my check in the mail, that applies to me. But maybe just taking a little bit of time and reading through and see how some of these things could impact you, especially if you are feeling the negative impacts, whether furloughed or reduced salary at work, to take a look at how some of those loans or ability, although we don't advocate it, but if you have to take dollars out of retirement plans and the ability to pay it back in. So I would look at it, and as we've spent time with the CARES Act over the past week, there's so many little pieces in there that I do think it's worth time to spend a little bit of time with it at a good solid summary of the plan and how the different pieces could potentially impact you.
Good, thanks. Yep, a lot of nuances, and it comes down to the individual situation. And then every day that goes by means that we're a day closer. We don't know when that day is. We don't know when we'll start to see the cases and that are coming out, the new cases decline, but it's coming. And every day that goes by is a day closer.
Yeah, I saw that ties in with a question that Alex had out there out there listening, that when the coronavirus is over, how soon will the economy snap back? And boy, it's very difficult. I think every day that goes by that we don't get our arms around the virus extends that period of time. But I think there'll be a lot of pent up demand in this economy when it opens back up. It's just it's all going to be reliant on when we get our arms around the virus and we can start to introduce people back to, not social distancing and maybe being able to get back together in smaller groups. But maybe we'll have social distancing forever now. I don't know. But really, Alex, it's going to be difficult for this economy to bounce back until we get the coronavirus behind us And I think there'll be a lot of pent up demand. So I think there's a good chance that we have a nice recovery, possibly in the fourth quarter, maybe no later the first quarter of 2021.
Yeah, I would agree. And going, there's another question regarding the real estate. If it takes a dive, would online enterprise teaming companies like Salesforce, Microsoft, Zoom, or other startup scale platforms be advised? I think that would probably be yes, but also caution. Particularly if you're buying something that's already been overpriced. Zoom, for example, we've already seen some headline news of security measures, of things of that nature. So you just got to be cautious on what you're going into. But I think those companies are already, like Microsoft, Salesforce, very well established. They might be buying up competition before competition even has a chance to be invested in. So those are things that we are definitely looking at. And technology is traditionally a sleeve in portfolios already. So I hopefully that answers your question.
Yeah.
Obviously something we're looking at.
Yeah. Yep, I agree. All
And
right.
I think one more thing, I know I brought this up earlier in discussion with you guys, but there's also, that's not in this CARES Act, it's kind of outside, but if you know anybody in the restaurant business, there is a special restaurant employee relief fund that's separate of this CARES Act that you could apply for and also get a $500 grant potentially in addition to the government $1,200. So if you know anybody in that industry, I encourage you to pass that information along to them as well, just to help them out.
Great. Well, Bill, Beth, Matt, thanks for joining us today and joining me today and bringing this webinar update in series. And thanks to all of you for watching today. This continues to grow with popularity, so we're thankful to be here for you and guide you through these really difficult times. We understand that. And if you know of someone that might be interested, feel free to share the link and have them join in. We'd be glad to have them. Next week, we will continue discussion. Again, give you a market update. It seems like things change very rapidly right now. Bring into the discussion some other key components that you should think about as we continue on in April. Until then, please be safe. Enjoy the weather this weekend. Looks like it's going to be a little nicer, and we'll see you next time.